An established downtrend continues lower. This candle by itself on August 24th would resemble a very large and thick doji representing indecision. However, it is directional, serving as more of a minor upswing to form this neutral to slightly bullish range off the 62 area, which forms a resting phase in this downward continuation that recently spiked down in mid-October. The downtrend moves along, but it quickly slows down once again due to a very sharp dragonfly doji and bull hammer in quick succession. Overall, it's not a very strong move, but there is relatively quick follow-through with the following candles trading and closing above higher, but the volume still remains low overall. Looking at the long-term context clarifies the situation further when 57.20 is revealed to be a very major support level to this long-standing downtrend. An inverted hammer quickly stops a minor downswing and maintains contact around the 57.20 area, with the most recent candle trading above the inverted hammer's high to build on the recurring bullish sentiment. This inverted hammer could have a longer upper wick and a shorter real body closer to the bottom 1/3 of the candle, but it still has the same general price action. And looking further ahead, this candle fully engulfs it with strong bullish volume to further emphasize the strength of the 57.20 area as a major support area. In the short term, it is a swift and strong rise, gapping back up, but when recontacting the 60 level, there is natural immediate opposition due to mainly this close from the continuation candle in mid-October. Heavy volume here, natural selling pressure, causes indecision as seen with these dojis. The minor downswing from 60 is not maintained, and the market continues on higher with relatively consistent volume that is low at first, but it eventually picks up with increasing green bullish volume towards 2016, and that allows for an easy pass above the more significant 62 resistance level that remains from the lower boundary of the large continuation seen earlier. There was some volatility around 62, but the market maintained contact with it, and this served as a consolidation period where the market used this as a temporary support in the climb back up higher. Lower wick rejection and continued green bullish volume at moderate levels allowed for the market to maintain a presence above 62 to move into 2016. Here there is an example of what is called an abandoned baby. It is a very rare occurrence, but it is a strong overextension. In this case, an overextension gapping too far down, and that results in an equally rapid rebound back up higher. It is called the abandoned baby because it is a candle that is essentially isolated from the candles before and after it, while at the same time it creates a reversal into a new trend, similar to the baby candle in a harami that forms a reversal. Normally, abandoned baby candles are relatively balanced like a thick, real-bodied doji. However, they can still form in other variations such as a bearish star, hanging man, inverted hammer, or bull hammer. But the key feature here is that it is isolated from the candles before and after it. And another key feature here, there is increased volume that often occurs around an abandoned baby due to the higher volatility and rapid fluctuation in price. Even if this candle did not emerge, an upward reversal or at least a pause of the medium-term downtrend was likely since 62 remained a major support level. Back to the lower 70s, and natural resistance results in upper wick rejection. That does not lead to an immediate downswing, which creates a very flat range for quite some time. This is a great demonstration of a bearish star and upper wick rejection at major resistance that leads to a pause and halt of an existing uptrend rather than a complete and immediate downtrend. In the long term, Walmart continues the recovery to continue climbing higher. The general price action shows upper wick rejection for both the bearish star and the central gravestone doji, along with increasing volume. Taking a look back, the round 90.5 level turns out to be a major upper range, and generally price has risen quite sharply in the short term, with the long term and short term context pointing to a more bearish situation. It may come as a surprise that Walmart actually continued higher quite strongly. Price rose instead due to the third quarter report, which is a volatile and unpredictable event in terms of the market's reaction. Such events like quarterly earnings are best avoided, since these are scheduled but unpredictable events in terms of the market's reaction to them. They essentially negate technical setups on the chart, like this seemingly clear bearish reversal. That is why it is often not suitable for medium and short-term traders to be trying to enter the market during these times, as well as long-term investors looking to enter or exit positions under more favorable conditions. 90.5 being a gap fill level naturally influences Walmart stock price, and during this steep drop, it is slowing down the downtrend, and on the way back up, it manages to start resisting with upper wick rejection leading to bearish to neutral price action at this major resistance area. Once again, there's a perplexing jump higher in the seemingly bearish to neutral context. It is another quarterly report this time. Such events don't necessarily result in a negation of bearish setups and a jump in price. That is just the result with Walmart stock in these instances. Major catalyst events such as quarterly reports can also result in price jumping down or remaining sideways, with varying degrees of volatility, all resulting in candles being less reliable during these periods in the market. Walmart stays aloft for some time longer, but eventually returns back to 90.5, where this inverted hammer is of interest. It shows upward intent at this significant support level, along with minor wick rejection of these two candles as well, showing the supporting features here. However, the tone is still neutral and eventually going more bearish due to this most recent candle, keeping the red surge going and having very strong volume. Walmart does indeed go lower, but not by much and not for long. These two most recent inverted hammers put further doubt into the longevity of the downtrend, and this most recent candle further amplified this with a strong close above their highs immediately. A major upward reversal was likely to develop further following the break above 90.5 once again. This is more of a downward overextension, taking the chart into oversold territory. The upward reversal over 90.5 isn't that strong. It is at normal volume levels. However, it is consistent with that strong row of green candles. It was more of a transition from strong red volume in the preceding downtrend gradually to more normal levels of increasingly green candles and volume, with barely any red candles heading into 2019. This relatively simple observation explains the stable and slightly slower climb back up into the 90s. It also highlights the importance of swift confirmation of reversal candles. In this case, the rapid trading and closing above the highs of bullish reversal candles. After this bearish star, these two candles are more like dragonfly dojis rather than hanging man candles due to their thinner bodies that are still concentrated towards the upper portion of the candles. Though the effect is similar to what would be seen with a hanging man candle, there is a drive lower during an established uptrend, and this puts doubt into further higher prices, leading to a more neutral to slightly bearish phase, more like a resting phase. If the market is likely to continue further up, it will eventually breach this minor downswing point and continue higher. It does indeed turn out to be a continuation, similar to the general price action of a 3 methods rising, with the strong green surge here, resting phase we just covered, and the further higher prices into the 100s with this row of green candles. A very strong bearish sign with strong upper wick rejection and increasing red volume. Remember, this 104 is actually a significant level as well, as it lines up with some major upper ranges of the past. In addition, the next candle allows for immediate confirmation of this bearish context, strongly closing lower with high levels of volume continuing, and this is actually too much too fast in the short term, leading to an overextension to the downside, which is why the market begins to flatten out here and move in a very narrow range for quite some time. It soon becomes clear 98.64 in particular is a price level of significance offering support due to the closing prices from these downswings and the quarterly report earlier. Naturally, this leads to an upswing that is slow to start at first due to the persisting red volume that remains slightly above normal into early April, and this green surge isn't with overwhelmingly strong volume, but it is very consistent. As would be expected, there is resistance with upper wick rejection returning back up to 104. However, the market only pulls back slightly to hold above the still relevant 98.64 level, and that eventually gives way to a breakout over 104, once again with volume that is not exceedingly high, but a row of consistent green candles. Then when there is a major market decline, the 104 level exhibits roll reversal, whereby a previous resistance now becomes a significant support, and interestingly, there are many closing and low prices concentrated close to this level. In some cases, such as with this dragonfly doji, a support like this 104 level can be so strong the market begins reversing without direct contact at that exact price level. Rather, it is more of a support range it is bouncing off. There won't always be picture-perfect proportions with the candles like those theoretical diagrams. Here, these are close to inverted hammers, but there is a portion here, especially with a longer lower wick, but overall it shows that supporting price action here, intent to drive higher with the highs, and the real body concentrated towards the lower portion, but at the same time the lower wicks are rejecting prices under the crucial 104 level. A familiar sight with the market climbing higher in the long term, and here is something interesting. The left chart shows the daily candles we have been looking at, and the chart on the right shows a 15-minute chart in the intraday time frame to allow for a view of shorter term context. That shows the intraday price action when these two bearish stars form on the daily chart. It highlights the general greater importance of open and close prices, especially on the daily time frame, and that is carrying over to the 15-minute time frame, as these same prices are also highly important during these formations. Most activity and interest in the market is concentrated around these opening and closing prices and the low and high prices to a lesser degree, oftentimes. And this also highlights the point that candlestick charting is essentially a summary of price action, and when time frames are combined, they are essentially charts within charts.